Just when we thought that things were finally stabilizing with mortgage rates, they've recently become more volatile and started trending upward. So in this video, we're going to talk about exactly what that looks like in 2023, how it'll impact you, whether you're buying or selling a home in Kansas City, and then we'll end with 5 key tips so that if you're buying a home this year, that you're not impacted by these super high mortgage rates. So as of February 21st, which was the beginning of the week when I filmed this, and I know you're seeing it on Saturday, mortgage rates stood at 6.813%. So just under 7%, not quite as bad as November and October of 2022, but it's certainly pretty high. It's one of the highest it is the highest mortgage rate we've seen in the past decade. And of course, all of the data that you're seeing on this chart kind of varies based on the credit score of the borrowers, the different lenders, the different loan options, but this is basically an average of all of those things. And we'll talk about how you can improve your odds and reduce your mortgage rate here at the end of this video. But for now, I want to point out that I know you've most likely heard that this is not a historical anomaly, that rates, even though they're the highest in the last decade, over the last 30 years, 7% is pretty average and a pretty good deal compared to, the 14 to 20% that we would have seen in the late 1900s. But the problem is that mortgage rates and home prices have been increasing at a rate that outpaces how much people's wages have actually grown, which puts us in a position where, we're losing money, the price of it is increasing, and on top of all of that, it's driven by dynamics in Kansas City's real estate market where demand is really, really high and supply is really, really low. And the same thing is true there. Supply just can't quite keep up with demand, even though it's slowly increasing. Now, in terms of the next few months, what this looks like for you if you're buying or selling is I think we should anticipate and prepare for some turbulence. And I've got some forecasts from real estate experts and economists and what they think that mortgage rates will look like throughout the rest of this year. So just expect some turbulence, but here we go. We're going to go one by one. The Mortgage Bankers Association says that mortgage rates will end up at 5.2%, and then in the following years, they'll average around 4.4%, which is a pretty good mortgage rate. The Bank of America says that they'll reach about 5.25 by the end of 2023. Morgan Stanley says 6%. Fannie Mae says 5.7%. Freddie Mac says 6.4%. Moody's Analytics says 6.5%. Goldman Sachs says 6.5% too. And Realtor.com is a stark outlier at 7.4%. So based on all of those quotes, I think we can probably expect mortgage rates, probably not the low end estimate of 5.25, and probably not the high end of 7.5 basically, but most likely we're going to find ourselves between 6% and 6.5%. Now, if you're selling a home in Kansas City this year and you're generally worried about interest rates and you're not sure how it'll impact you, I think you can rest easy knowing that the market is still so tight, there's still such a lack of inventory, and there's an overwhelming amount of demand to the point where there's a good big crowd out there who has to buy a home despite these high mortgage rates. And I'll talk about it specifically, the strategies that you can implement if that's you and you're buying a home here in a minute. But if you're selling, I don't think it's going to be a situation where you're going to have to drop your price or it's going to take months and months and months and months to sell your home. I think there's still demand out there. You're going to get it sold, but it might be a question of small price drops, not being super aggressive on the price, and potentially offering financial incentives like a rate buy down to reduce the monthly payment that your future buyer might have to pay. If you're buying a home in Kansas City this year and you're worried about those fluctuating mortgage rates, because I get it, it's a huge hit to your bottom line every single month and your finances. So here are the top 5 tips to help protect you from that storm. Number 1 is work on the credit score first. You're going to save so much money because the impact your credit score has on the mortgage rate that the bank charges you is huge. It is mind-boggling. Here's a chart that'll show you the difference in your monthly payment with a 680 credit score and a 740 credit score. And look, I know nobody wants, it's boring, nobody wants to think about it, but this is a situation where the payoff is so grand, it's certainly worth it. So some other tactical tips look like paying off your credit card as frequently as you can, so that way your revolving utilization is low and your credit score can slowly start to increase. Another one is those afterpay situations that you'll see online where they'll charge you 0% interest and you'll pay in 4 installments. Those will have some impact on your credit score and certainly impact the balance that you're carrying, which is what all of the credit bureaus are looking at when they assess your score. And obviously, if you've got any type of credit card debt, let's attack that first because it's probably 20 to 25%, and we want to get that out of the picture before we start to think about an 8% mortgage rate. Now, this next one makes so much financial sense to me, but I know not everybody will have the option to do it, but if you're creative, you can certainly make it work. It's private financing. See, instead of going to the bank, why not negotiate a deal with friends or family if that's an opportunity that you have access to. There's so much flexibility, and hear me out here. This could either be a standard 30-year mortgage, or it could be whatever you negotiate and decide it is, which could look like a loan that only lasts as long as you need it to until mortgage rates finally start to decrease to acceptable levels. This could also be for the full purchase price, part of the purchase price, or even just the down payment. It could be interest only or interest and principal. There are so many options with this one. If this is something that you can do, I would absolutely recommend it. They win because they're going to be making more money from the interest you pay them than they could in a bank or putting their money in a bond. You're paying less than market mortgage rates, that 6.8% that I showed you. And on top of that, you're keeping your monthly payment low while giving you the room and time to wait for rates to finally drop. The other hidden benefit is that you're paying today's home prices instead of the higher home prices, the almost certainly higher home prices later on once rates finally do normalize. Number 3, and not everybody will have the opportunity to do this, but most of you viewing this channel, I believe, have a home to sell and you're going to turn around and buy a new home as well. So what I'm seeing in this instance is taking all of the equity from that home sale and putting all of it towards the new home, instead of what happened the past couple of years, which is we'd only make the minimum or a sizable down payment but not put all the money into it. We'd put the rest of the equity from our previous home in the stock market, bonds, or even many people would buy a car with that money. Instead of putting that money elsewhere, you could put it into the new home as a down payment, so then you don't have to borrow as much money and you can keep your monthly payment a little bit lower, which means you pay the bank less money to borrow it. Number 4, this is a huge one and it's been happening, which is all of the people who got a really low, historically low mortgage rate over the past 2 to 3 years of 2% or even 3%. My best advice for you all, hold on to that home. See if you can renovate instead of buying a whole new home. But keep in mind that everybody's doing that. Everybody's starting to renovate their home and instead of buying a new home or building a home even, and contractors have been backed up. But I think this is certainly a good option, especially if you've got that 2 to 3% rate locked in for the next 30 years. I know it might sound odd coming from a real estate agent that you should stay in your home and not buy a new home, but I truly think that you should. It makes a lot of financial sense to protect and hold on to that 2 to 3% interest rate, because I don't think we're going to see that again anytime soon. Plus, based on where inflation's at right now, you're making money. Now, the 5th thing that you should look out for are mortgage traps. And there are 2 big common ones, but it all depends on how long you're going to stay in this home. If you're staying in this home for under 5 years, the 2 traps you should avoid are buying down the interest rate. It might not pay off after 5 years. Sometimes it takes as long as 6 to 8 years for you to even break even if you spend all of that money to reduce your mortgage rate. The second one is the idea that we can buy it now, even though we're uncomfortable with the high mortgage rate, and just refinance when rates drop. But again, if we're only in that home for about 5 years or less, then why spend the money on the closing costs? Why spend the money to buy the rate down if we're not going to get a return on that investment? However, if you do the math and everything checks out, I think it absolutely makes sense to take that rate buy down incentive, or buy down your rate on your own, or even think about refinancing if this is the forever home that you see yourself in for the next 20 years. Now, I know all of that is general advice. Sometimes it can get stale and the financing stuff gets boring at times. If everybody's situation is different. So if you're looking for personal recommendations about how you can protect yourself, whether you're buying or selling a home in Kansas City from these treacherous and volatile mortgage rates, I would love to help. All my contact info is in the description. Give me a call, text, and email, and we can talk about where you're at and how we can use the stuff in this video to protect you even more. If you enjoyed the video, hit that subscribe button, like the video so other people see it, and I will see you on the next one.